Capital gains tax structure needs to be re-examined by Tarun Bajaj. India's capital gains tax regime has become too complicated, and it is time for a relook, Revenue Secretary Tarun Bajaj said at a post-budget interaction with business leaders on Wednesday. Bajaj said the government has done some groundwork comparing the capital gains tax regime with other countries and used the occasion to seek suggestions from business leaders in the next 3-4 months. Addressing business leaders at the interaction organized by industry body Confederation of Indian Industry, Bajaj said an absolutely fresh look is needed on the capital gains tax regime. Bajaj said the first issue requiring a fresh look was the capital gains tax rate itself, and the second was the holding period as the framework has become too complicated. For real estate, we have made it 24 months, for shares, we have made it 12 months, for debt, it is 36 months. So, we really need to work on that, Bajaj said. The capital gains tax regime prescribes the holding period for determining whether the gain made at the time of selling the asset is short-term or long-term. Short-term capital gain is taxed at a higher rate than long-term capital gain. The holding period and the tax rate differ depending on the asset class, whether it is property, movable assets such as jewelry, listed shares, and equity-oriented mutual funds or debt-oriented mutual funds. In certain assets such as property, short-term capital gain is taxed as per the income tax slab. Long-term capital gain from listed equity shares of more than 1 lakh attracts a 10% tax without the benefit of indexation or accounting for inflation. Bajaj also said that one hurdle is that any tweak in the regime would mean there will be gainers and losers compared to the current regime. That becomes the difficult part, he said. He told business leaders that the lower corporate tax regime for new manufacturing units was extended till the end of March 2024 because there was a demand from businesses for more time to make use of the scheme, given the pandemic situation. The due date refers to the time available for new factories to take advantage of this scheme to start production. Bajaj said that capacity utilization in the industry has improved, and many industry representatives have disclosed capital expenditure plans. So, I presume that 2024 is more than 2 years from now. We should see some activity there, Bajaj said, expecting the industry to make fresh investments in the coming months. The Revenue Secretary also explained that if there is more revenue buoyancy in FY23 than suggested by the budget estimates, it could prove to be a buffer for any unexpected funding requirements, as had seen in recent years. Bajaj said that if any extra spending for vulnerable sections of society is needed, it has to be provided, and that there was no second thought on that. His comments about the budget-making exercise imply that the actual collection of certain revenue items could exceed initial estimates for FY23.